Hi, everybody. Welcome to our TCLE Top 10 Tactical and Strategic Issues for Fiduciary Income Tax Return Preparers. I'm Steve Gorin. With me is my partner, Laura Duncan. Before we get started, I have some housekeeping. This program is eligible for CLE, and CLE certificates will be sent once we verify attendance. If you're seeking CLE for this seminar, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in the verification form included in the login instructions sent to you. All CLE questions should go to cle-tc@thompsoncoburn.com. And as I said, I'm here with my partner, Laura Duncan. We're both in the private client practice group at Thompson Coburn, and we both do a lot with fiduciary income tax. We're going to be having a very, very brief review of the fiduciary income tax and then talk about strategic income tax planning, which is important for not only doing tax returns but also administering trust as well as drafting trust. And then we'll get into 10 tips for fiduciary income tax preparers. So now we head for slide 3 with Laura.
Good afternoon, everyone. We're just going to briefly go through the Form 1041. It is produced on slides 3 through 7. We're not going to spend a lot of time today going through the whole form. I just wanted to bring up a couple of points. The overall purpose of the 1041 is dividing trust income between that which is taxed to the beneficiary and that which is taxed to the trust. And line 18 on the first page has the income distribution deduction, which is a deduction to the trust and flows out to the beneficiaries on Forms K-1 to show what is actually taxed to the beneficiaries. And that's really what we're going to be talking a lot about today is whether it makes sense to tax the income of the trust to the trust itself or carry it out and have it be taxed to the beneficiaries. The only real change I wanted to note on the 2016 Form 1041 was the new extended due date, which is now September 30th. So with that, we're going to skip to slide 8 and talk about some of our strategic income tax planning issues. And today we're just going to cover some of these here. First, who is best taxed on gross income, the effect of kiddie tax on rates, who benefits most from deductions, state and local income tax, and considering trust purposes.
Okay, so now we're on slide 9. So increasing a beneficiary's adjusted gross income can cause some tax issues. So again, when the income comes on the K-1 and the beneficiary reports it on the front of the beneficiary's income tax return, then of course it's going to be subject to income tax, but it affects more than just the tax rate. So one of the ideas is that on the itemized deductions, which is Schedule A to an individual income tax return, the overall itemized deductions are reduced by 3% of the excess of the adjusted gross income over the relevant threshold. So if you think about the top tax bracket being at 40% roughly for an individual, and you take this 3% reduction, 3% times 40% is an additional 1.2% additional tax. So in other words, an individual who's in the top bracket is actually paying tax at a 1.2% higher rate than a trust that's in the top bracket. Additional issues caused by increasing beneficiaries' income are the following. So some itemized deductions are reduced. For example, medical deduction is reduced by 10% of a person's adjusted gross income. Miscellaneous itemized deductions like tax preparation fees, investment advisory fees, those are reduced by 2% of the adjusted gross income. Also, there's an alternative minimum tax, which tax reform might very well do away with at some point. They're talking about doing away with it, but we'll see what happens. And alternative minimum tax basically disallows a lot of deductions. For example, it disallows miscellaneous itemized deductions. Anything that's remaining after that 2% subtraction gets disallowed for AMT purposes. but there's a significant alternative minimum tax exemption. And when you have high income, then the AMT exemption gets phased out and eventually lost. So people get a kind of a surprise when they have a big capital gain in their particular year, because that may wipe out their AMT exemption and cause them to be subjected to alternative minimum AMT. So also your income may phase out the personal exemption, and your income might also subject you to net investment income tax. So the net investment income tax is a 3.8% tax on investment that was enacted to fund the Affordable Care Act. Now, again, with tax reform, they're talking about doing away with the net investment income tax. It's kind of a little bit more unknown in some other aspects of tax reform, because they're talking about repealing the Affordable Care Act and then replacing it with something else. And there's the net investment income tax helps to fund the Affordable Care Act, and the replacement might also need funding, so the net investment income tax might be needed for the funding for the replacement to the Affordable Care Act. So we don't know whether it's going to get done away with totally, or they might keep it around to take care of the replacement. Also, consider the beneficiary's loss carryovers to offset income. And there's some big issues that can occur sometimes from year to year with beneficiaries. So let's consider, for example, what a capital gain rate might be. So a capital gain rate might be the same for the beneficiaries for the trust if they're both in the top bracket. But suppose a beneficiary had capital losses in the prior year. Well, those capital losses would be carried forward to the current year, and if the beneficiary receives a distribution of capital gain, those can be offset by those capital losses. So instead of being taxed at the top capital gain rate, they're actually taxed at zero because they're offset by the losses. So if the beneficiary has a loss carryover like the capital loss, that can offset income and therefore put the beneficiary into effectively a lower bracket. Similarly, the beneficiary may have not operating loss carryovers, et cetera, which is the code word, which is compare, because the secret word for compare, we're comparing the beneficiary's bracket to the trust bracket.
Slide 12, we're talking about the effect of the kiddie tax. So obviously, if we have trust beneficiaries who are not adults, we have to consider the fact that they would be taxed at their parents' tax rate, and that applies to children under the age of 18 and certain students who have not attained age 24. But it is important to note that there's no rule coordinating the net investment income tax for those purposes. So in other words, this 3.8% tax that Steve was talking about, children may still have a low enough AGI that they would not be subject to it, even though for regular income tax purposes they're being taxed at their parents' tax rate. So it still may be beneficial to shift the income out to those children and have it taxed to them. We want to think about who benefits most from deductions available. And we note in the first bullet point that for non-grantor trust, deductions can directly offset income before allocating the income out to the beneficiaries. And it's worth noting that there is a difference on the first page of the 1041. Some deductions are subject to a 2% haircut or floor, and some are not. So the differential there is those expenses that would be associated with trusts and estates uniquely are not subject to that. But, for example, investment advisory fees would be subject to that 2% floor. Also, charitable deduction limitations, trusts offer more flexibility in terms of the timing of deductions that individuals might have. For beneficiaries or individuals, charitable deductions are only deductible in the year that the contribution is made, whereas for trusts, they could be deductible in the current tax year or the immediately preceding tax year. So that offers a little more flexibility if the charitable deduction is available to the trust.
So again, you're able to, just to restate what Laura said, you're able to borrow from the next year's charitable contributions. So when you're doing your 2016 charitable tax return in 2017, if you would like to get more deductions for your 2016 return, then you can make a charitable contributions anytime before December 31st, 2017, and use that on your 2016 return. So that's an important tax planning idea we have right now.
We're comparing state and local income tax rates, which is also important in determining where the income is best taxed, and comparing what the trust state income tax rate versus the beneficiary's rates. And it's important to note that non-residence trusts would escape taxation in that only business income earned by a non-grantor, non-resident trust would be subject to that state's income tax. So oftentimes if you have no beneficiaries who are residents of that state, you would have a non-resident trust or estate or a non-resident trust, and therefore the trust may not be subject to state income tax. Also important to look at the effect of grantor trust status. If you have a grantor trust and the grantor moves to a state that has no income tax, such as Florida, then you may be out of paying taxes on that trust. So it's important to take note from year to year where the residents of the beneficiaries and the grantor are.
So again, you move to Florida and then you either turn off grantor trust status during life, or the person dies and then it'll be a Florida trust even though it was originally created in Missouri, for example.
Right. Also, just important to consider the purposes of the trust. So we're talking a lot today about comparing tax rates between the beneficiaries and the trust, but also have to consider, does it really make sense to make a distribution from the trust? Does that undermine the other purposes of keeping it in the trust? And we've just put some examples on here. If the beneficiary has creditor issues, it may not make sense to make a distribution out to the beneficiary. If the beneficiary is a spendthrift or has addiction issues, the tax issues are obviously not as important. It's more important to consider the purposes of the trust in those instances. And also looking at what the estate tax rate is on the beneficiaries. So to the extent a distribution is made and it's part of the beneficiary's estate at the beneficiary's death, it would be included for estate tax purposes. And we've noted that obviously with the increase in the estate tax exemption, this may not be as big of an issue as it was in the past, but still something to consider.
Some of the strategies that we're going to discuss is distributions after year-end to carry out income to beneficiaries, capital gain elections, charitable distributions, possible change in the beneficiary's residence, as Laura mentioned about the state income tax issues, material participation for businesses or rental activities, making the trust a partial grantor trust as to a beneficiary, making the trust a complete grantor trust as to the beneficiary, the ability to trap income in a trust notwithstanding distributions, which might be surprising to some people, maybe many people, and also maybe modifying a trust to make it more income tax efficient.
The other thing we're going to talk about briefly is just helping the trustee provide annual notices to the beneficiaries, which could reduce the liability exposure to the trustee and hopefully shorten the period during which a trustee could be sued. Going on to slide 22, we have our next code word, which is notice to the beneficiaries. The first tip we were going to talk about today is distributions after year-end to carry out income to the beneficiaries. So it's important to do rough drafts of the 1041 right now so that we can consider utilizing the 65-day rule, which allows, which if an election is made, it would allow a distribution to be made during the first 65 days of this calendar year to be treated as a distribution for 2016. So those distributions would need to be made by March 6, 2017 in order to qualify under the 65-day rule. And also these distributions could possibly carry out capital gains, and we're going to talk about that a little bit further.
With capital gain elections, so first of all, the tax preparation software, the default is that a trust income tax software will trap the capital gain inside the trust even if you've made big distributions. So when we talk about doing things to carry out the capital gains, you need to pay attention to what's going to be required in your tax preparation software to change how that works. The top rate for capital gains had been, until 2013, it had been 15%. And then in 2013, there was a new bracket that has an additional 5% capital gain rate where you reach the 5% capital gain tax. Just over $415,000 for single people, just under $467,000 for married filing jointly. But trust, it's only at $12,400 you reach the top capital gain rate. So very quickly you get to that top rate. So there may be a lot of times when a trust on the top capital gain rate and the beneficiary's income is significantly less than those thresholds. And so from a federal income tax point, you'd be better off taxing it to the beneficiary than to the trust. Again, we have the 3.8% tax on net investment income, which, again, for single people, the threshold is $200,000. For married, it's $250,000. But again, for trust, it's only $12,400. So this additional 3.8% tax on capital gains, again, that's taxed at a trust at a much lower level than it is for an individual.
So we're going to talk about some of the capital gain issues and how it is possible to carry out the capital gains to the beneficiaries, because generally gains from the sale of capital assets net of losses are excluded from distributable net income, or D&I. But the regulation that's cited on slide 28 explains when capital gains from the sale of assets are actually included in D&I. And there's three instances when that can occur. The first, when capital gains are allocated to income. The second, when capital gains are allocated to corpus but distributed consistently. And the third we reference as the 65-day rule distribution, and that's when capital gains are allocated to corpus but actually distributed to the beneficiary or utilized by the fiduciary in determining the amount that is distributed to the beneficiary. In the first bullet point, we talk about the power to adjust principal, and this is a discretionary power that a trustee could exercise when trying to give some impartiality among the beneficiaries. We know the income beneficiaries want income and the remainder beneficiaries want growth. So the power to adjust allows the trustee to invest for total growth and allocate part of the growth to the income beneficiary. And if the capital gain is actually distributed to the income beneficiary, it seems fair to tax it to them. So the Uniform Principal and Income Act generally allocates capital gain to principal, but the exceptions to that are this power to adjust as well as the power to convert the trust to a unitrust. For the power to adjust, the nice thing about that is it allows flexibility. There's no duty to do the same thing year in and year out, whereas a unitrust, you're locked into a fixed percentage every year. The trust agreement itself can actually allocate capital gains to income and therefore override the rules of the Principal and Income Act. But the regulations provide that the trust cannot depart fundamentally from traditional principles of income and principal. So we suggest that a 3 to 5% rule for the trustee should generally be a safe harbor, because that's generally the range for unitrust. So if the trustee was to make distributions within that range, it seems like it would be well justified.
Let's talk about the second exception, allocated to corpus but distributed consistently. So what you need to do is look at the first time that the following situation arises. During the year, there's a distribution of corpus, so the distribution exceeds your trust accounting income, and during the year, there was capital gain. The first time that that occurs, generally, if you decide to allocate capital gain to the beneficiary, then you have made an irrevocable election to do that forevermore. Similarly, if you didn't allocate capital gain to the beneficiary, then you have elected not to do that. Now, for most existing trusts, again, there's tax return preparation software will typically trap the capital gain on the trust. So most existing trusts, you have elected to trap the corpus inside the trust, at least for purposes of this particular exception. And so for this particular exception, you're kind of already stuck. For a new trust, you often do want to allocate capital gain to D&I unless the beneficiary is in a higher federal and state combined bracket. Now, that's a general rule. The better rule is to not make an election at all on this. The third exception, because these are all alternatives, if it's allocated to income or it's distributed corpus or it's under this third one, any one of those three you can carry out capital gain. So the question is, so first of all, tracing an actual distribution is not very practical unless you terminate the trust. So if you sell your asset in June and then you make the distribution in December, it's really hard to say, well, my December distribution was of the money that I collected in June. So tracing often doesn't work. On the other hand, if it's the very last year of your trust, we know that everything that you did is being distributed. So when you terminate the trust, then you can trace for that. But otherwise, tracing is a little bit more difficult. But we don't have to trace. The rule says that you either actually distribute the capital gain or you refer to the capital gain in making your distribution decision. So Laura mentioned before that any distribution that's made in the 65-day period, so any distribution that's made between now and March 6th of 2017, any distribution made during that period can count as a distribution for 2016 or 2017. So let's suppose you're doing one of these 65-day rule distributions, and you say, I want to distribute $20,000 of my 2016 income. And you just put in your trust records, I am distributing $20,000 of my 2016 capital gains. You put that one sentence in your trust records, you've made that election under prong 3, and that's sufficient to be able to carry out the capital gain. And so then you're in this more flexible rule, and you haven't made that irrevocable election under the second prong, and then you can decide from year to year what you want to do. And you can also be inconsistent from year to year. Now, let's take a step back for a moment and just talk about how this might work for when you have budgeted distributions. So let's suppose you're making distributions of $5,000 a month to the beneficiary, or $60,000 a year. If you're doing that, and that's just you're doing that day in and day out, come hell or high water, you're really in item number 2, typically, because you've decided how much is distributed on your ascertainable standards, and you didn't do it through a power to adjust. That was just what you decided to do for your principal and your income combined. So then you're in exception number 2, so you're in inflexible territory there. Now, suppose that it wouldn't really do much damage to make an extra distribution. So let's go back to my 65-day rule distribution of $20,000 of capital gains. So let's suppose that right now you said, let's make a distribution referring to the $20,000 of capital gains from 2016. So you're referring to that, and you made this big lump sum distribution. Now, when you determine the beneficiary needs for 2017, you could say, well, the beneficiary already got this $20,000 lump sum, so maybe we'll skip 4 months, maybe, April, May, June, July, we'll skip those 4 months of the $5,000 distributions. So we'll skip those months, and they already got the money, so they have enough to live on, and this way we've carried out our capital gain, but we haven't done any harm to the budgeting. And so just have a little bit of an open mind on how you might change the way your budget distributions go. Now, that might not work for all beneficiaries because beneficiary might get the $20,000 and go spend it all. Yes, go down to some of these gaming boats or whatever and spend all the money, and then they'll be out of luck for those 4 months, and then they might be upset. So it won't work for everybody necessarily, but it is a potential strategy.
So slide 33, we're just talking about some of the fairness issues, and is it fair for the distributions to carry out a capital gain? Steve was talking about you have to have beneficiaries under certain circumstances for these rules to sometimes make sense. And if you are making a distribution to a beneficiary for a particular purpose, they may be upset when they get a tax bill associated with that distribution. So one thing that the trustee could do would be to gross up the distribution so that the beneficiary could use that gross up piece to pay the associated taxes on the distribution made to them, obviously understanding that the gross up distribution itself would be subject to tax as well. So these are some of the things the trustee needs to take into consideration if these distributions are going to be made and potentially carry out the capital gains to the beneficiaries. Talking about whether distributions are advisable, and there's a couple of issues. Are distributions available under the provisions of the trust? Obviously, to be able to make some of these decisions, there has to be sufficient flexibility in the trust for the trustee to potentially make distributions to the beneficiary to carry out the capital gains or make some other decisions. And also the trustee has to consider what are the protective nature of the trust itself. Does it make sense, even putting the tax issues aside, to make these distributions out to the beneficiary? This is actually, are distributions really available to be made from the trust? And we look at what are the standards by which the trustee can make trust distributions. Is it an ascertainable standard, which we lump into the term support, or are they broader standards? Are they welfare distributions? Also, the trustee has to...
Well, welfare distributions would be for any reason whatsoever in the trustee's sole and absolute discretion. So that's what we're really talking about.
And also the trustee has to look at the trust agreement or state law as to whether they have to consider the other resources of the beneficiary. And typically in our documents, we give the trustee a lot of discretion and say they may but are not required to consider the other resources of the beneficiary in determining whether a distribution could be made.
And mainly the exception for that would be like if you have a beneficiary and you want to restrict their spending, like you might have a second marriage and you want to preserve some money for the kids, so you might want to distribute only enough that whatever the surviving spouse really needs. So that's really about the main time when you want to cut down on those. Make them required to consider the other resources. Another consideration, as Laura mentioned earlier, some of the trusts might have been formed at a time when the beneficiary had a potential estate tax. So, for example, we used to have a $1 million exemption. In 2013, that got permanently upped to $5 million. We'll see what it might go to in the future, but it could be that the beneficiary had a potential estate tax problem and now doesn't have one anymore because maybe they're in this $1 to $5 million range. So maybe having it in trust is not necessarily such a benefit because it's not saving estate tax anymore, but what it really is doing is it's causing a loss of basis step-up. Any assets that are inside this trust that are not included in the beneficiary's estate, those are going to pass to the next beneficiary without a basis step-up because they're not included in the beneficiary's estate. So you might consider also having a distribution in kind to get the basis step-up. So, for example, you might have a stock with a very low tax basis relative to the value. If you can distribute that out to the beneficiary and then the beneficiary dies, it'll get included in their estate, it'll get a basis step-up, and because their estate is below the threshold, it'll be a free basis step-up. So I heard Reed Moore Heckerling once talk about free basing. So that's what that would be. Also consider the very protective nature of the trust, and I kind of view there as being three different types of beneficiaries. So some have very real creditor or spousal issues. So if you make a distribution of them, it's going to go right into the hands of the creditor. It's not going to benefit them at all. So you want to leave money in the trust. I'd rather, pay a little bit more tax and at least still have the money around than have it go directly to that creditor or ex-spouse. Another issue might, again, be burning a hole in the beneficiary's pocket. Maybe they're pretty good people, but as soon as they get the money, they spend it. And so you might not want to be distributing it out to them. But another might be a beneficiary who's generally a pretty good saver. One day they might have creditors. So we have these trusts just for estate tax flexibility, protection against hypothetical future creditors. You never know when they might get into a car accident. Even if they're a careful driver, eventually they might, get older and not as physically able, and they might get into a car accident then. So they might one day have creditors. So for this type of beneficiary, the trust is good to protect them against some of life's vagaries, but really the biggest creditor here is Uncle Sam. You have to pay them income tax. We'd rather avoid paying the tax, so save tax now might be more important than the hypothetical future creditors. So for those beneficiaries, those are good people to be able to make distributions to. So you really don't want to have the tax tail wag the dog, so that goes on to the next code word on the next slide, which is dog. Not having the tax tail wag the dog, we really need to balance these competing interests of taxes versus the trust purposes.
So slide 40, we're talking about ideal trust distribution provisions. And again, if you're in the planning stage, this is really the time to think about flexibility and being able to make distributions to the beneficiary if and when the time comes to potentially save taxes. So if most of our GST trusts have ascertainable standards to be excluded from the beneficiary's estate, and we often use a broader standard than just necessarily support. We may use a reasonable support and comfort standard, which is still considered an ascertainable standard, but indicates that the discretionary distribution is broader than simply satisfying support obligations. We also may allow distributions for welfare, even in those trusts that are intended to be excluded, if we allow the appointment of an independent trustee, and that's somebody that's not a related or subordinate party who can make much broader distributions for the welfare of the beneficiary. And we also may consider adding a 5% withdrawal right that's exercisable towards the end of the 65-day rule that the trustee could turn off. So if the beneficiary, for example, had creditor issues, as Steve was talking about, the trustee could actually turn off this power. So it's a great way to give flexibility in terms of making distributions out to the beneficiary. Again, the idea of having a related or subordinate party who could make welfare distributions to the beneficiary, and I think this was Revenue Ruling 9558 that this was authorized. So distributions then, if you allow for these principal distributions for welfare, could carry out capital gains and use some of the rules that Steve talked about, which when you have a distribution of corpus could actually carry out the capital gain to the beneficiary. Also helpful to have a welfare distribution standard for decanting purposes. A lot of states have enacted new decanting statutes, including Missouri, which would allow a trustee to move the assets from the current trust to a new, potentially more suitable trust, including causing estate tax inclusion at the beneficiary's death and get that basis step up.
Charitable distributions will reduce a trust's adjusted gross income. So this is a key difference between the way that trusts and beneficiaries are taxed with respect to charitable distributions. For individuals, charitable distributions are itemized deductions. And for trusts, they reduce adjusted gross income. Now, as itemized deductions for individuals, tax reform may have a big impact here. Part of tax reform is the idea is to lower income tax rates and at the same time reduce the ability to deduct things. For example, there might be a limitation on the overall itemized deductions that somebody can take. And there's some even talk that maybe charitable contributions might not be deductible to the extent they exceed more than $100,000 or $200,000. So it could be that an individual would not even be able to deduct the full amount of their charitable distributions, whereas if you can do that from a trust, then you can deduct it. And in fact, one strategy, which is a little bit beyond the scope of this discussion, though, is what's called an incomplete gift non-grantor trust or an ing trust. So those of you who want to look into some literature, you can look up what an incomplete non-grantor trust is. But that would be a way for a very, very wealthy person. They put assets into this trust. There's no gift tax consequence, and then the income from that trust can be offset by the charitable deduction. Also, as an itemized deduction, the charitable deduction does not offset net investment income. But for trust, it does. Just different rules for trust or individuals. So again, the charitable distribution is much more favorable coming from a trust than an individual. We already talked about the idea that distributions to charities can count flexibility for either the current year or the prior year. Another point is that trusts need to be from gross income. So the trust needs to earn the income before you make the distribution. So typically you would be making your trust distribution to charity at the end of the year, or you might make it in the next year and then count that for the prior year. The trust instrument also has to authorize the distribution to charity, and the IRS has been cracking down on this. In fact, I think the charitable income tax distribution is about the only thing that the IRS is auditing nowadays on trust income tax returns. So beware, the materials go into that in more depth.
Again, noting that it's important to look at the residence of the beneficiary from year to year, and I guess an overall point here is don't rely on what you did last year and assume that the same thing applies this year. Just as a planning tip, it really is important to take a fresh look at some of these issues, including the residence of the beneficiaries. So a trust could have been, for example, a Missouri resident trust in past years because there was at least one Missouri resident beneficiary, but there's basically a snapshot taken at the end of the year. So if all of your beneficiaries have moved out of the state or no longer live in the state at the end of the year, you suddenly have a non-resident trust, and a non-resident trust is only subject to tax by that state on its business income. So it's really important to look at all of these issues in determining what the status is of the trust as a resident or non-resident trust.
Okay, so now we get into owning business interests, and this gets into the net investment income tax, which again might very well be repealed. But
definitely still in place for 2016.
Definitely 2016, absolutely. And the other point is that they've talked about in tax reform taxing business income at more favorable rates than, like active business income, at more favorable rates than other types of income. And so there might be a difference between active business income and passive business income. So this is not the net investment income tax, but whether the trust might be eligible for a tax break for having an active business. So even though this is important for net investment income tax for 2016 and possibly 2017 and future years, it also might be important under tax reform for active businesses. So we'll see how it goes, but it is important to listen and get at least slightly attuned to what's going on here. So business income avoids the net investment income tax if it is an active business income. And if the trust is a non-grantor trust, then you need to be documenting the trustee's participation. If the trust is taxed to the deemed owner under the grantor trust rules, then the deemed owner's participation is what counts. However, as we'll discuss in a moment, it may be important to have the trustee participate because the trust might not always be a grantor trust. Another important issue that can come about is suppose the trust owns some rental real estate, or maybe a business that has some real estate, or just other depreciation. Trust income tax will actually let you pass some of this depreciation separately through to the beneficiary. So instead of offsetting it against the business income on the trust return, it simply reports this as a standalone deduction to the beneficiary. And so the beneficiary's participation can trigger depreciation deduction. So I've actually had a situation where a lawyer I work with called me up and said, Steve, we have these trusts that the trustees don't participate, but the beneficiaries do, and is there any way that we can get a deduction for this depreciation? And the answer was yes, these are separately stated items. They appear separately in the K-1 for the beneficiary. The beneficiaries participate, so we're fine. We don't have to worry about the trustee. We're going to discuss what QSSTs are a little bit better in a moment, but if you do have one of these animals, the beneficiary is taxed as the deemed owner of the S corporation stock, except when it has the gain on the sale of the business assets. So these allow the beneficiary to run through all the lower brackets before getting to the higher brackets. So I had a situation that came to me once where somebody had they were late in making their appropriate trust elections for the S corp, and they wanted me to help get it fixed, and there's a mechanism for doing that. But before we did that, since this was a new trust that was created when the first spouse died, I did a little bit of troubleshooting just for long-range planning for that trust. And I asked, how does the surviving spouse's income compare to the trust income? What kind of tax bracket is she in? And the CPA came back to me and said that other than the income that might be coming through from this trust, her deductions offset all her income. So she was in the lowest possible bracket. Now, if the trust had been taxed at the trust rates, if the income for the S corp had been taxed at the trust rates, it would have been taxed at the highest bracket. But instead, I said, let's make it a QSST and reform the trust and make it a QSST so the income is all taxed at her bracket so she can get the full run-up in her brackets. So the QSST allows you to tax the S corporation income at the beneficiary's rate rather than getting it trapped in the trust and taxed at a higher rate. Again, we'll talk about that a little bit later. And then there's a special planning for the sale of a business by a QSST, so I just refer you to those slides. I don't want to get into too much detail in this one-hour seminar. So how does material participation work for trust? Well, again, a QSST is a grantor trust that's taxed to the beneficiary, and so the normal K-1 items would get taxed directly to the beneficiary, and you would look at the beneficiary's participation. If the QSST sells all of its stock, or if the S corporation sells all of its assets, then it's taxed to the trust, and you're going to be looking at the trustee's participation. And if it's an electing small business trust, which we'll get into in a moment, you look to the trustee's participation for the non-grantor trust portion of that. So you really do want to look at the beneficiary and the trustee participating in the business.
Talking about making a trust a partial grantor trust as to the beneficiary, and if there's a way to do this, then over time, the percentage increases to which the beneficiary is treated as the grantor and therefore taxed on the trust income. So rather than the trustee making an actual distribution to the beneficiary, the trustee could exercise its discretion and credit it to the beneficiary and allowing the beneficiary the right to withdraw the lesser of 5% or $5,000 of the trust assets. And when this withdrawal right lapses under Code Section 678, it makes the beneficiary a grantor as to the trust, and that portion to which the beneficiary is treated as the grantor increases over time. So never get to 100%, but over time the percentage increases. The one issue with this is it cannot be turned off. So this is a permanent change to the trust, and the beneficiary will always be treated as a partial grantor as to the trust. So this may or may not be a beneficial thing, but just a strategy to consider if it's important for the beneficiary to be taxed on the trust income.
And I was remiss at the very beginning. These numbers in parentheses you see there at the top, we have standalone separate materials. Those are to sections of those standalone materials. So that's where you get all the details to the things that Laura and I are saying. So let's talk about how you might be able to make a trust, a complete grantor trust, as a beneficiary. So what you might do is the trustee contributes its assets to an S corporation. Then the trust converts to a QSST. And there may be a provision often in the back of your document that says that if the trust ever owns S Corp stock, that it can convert to a QSST. And then again, the QSST is taxed as a grantor trust deemed owned by the beneficiary. So this also is a very important drafting tip. So in terms of converting to a QSST, a lot of old forms I've seen say that you can convert to a QSST if that's the only way it will hold S corporation stock. Well, a lot of those old forms originated before 1997 when electing small business trust became available. You don't want your form to say that. What you want to do is have your form say that you can convert to QSST if the trustee deems it's advisable. And typically you'll have an independent trustee, which, as Laura mentioned before, this person is not a related subordinate party. So convert to QSST. Now that might increase the beneficiary's rights. A lot of QSST conversion forms say that the QSST becomes a mandatory income trust. And as we'll discuss in a moment or two, you don't have to do it that way. We'll talk about that in a moment. The nice thing about a QSST is you can turn it off. The trustee can make an ESBT election, and boom, now the trust, all the income is trapped inside the trust instead of being taxed to the beneficiary.
So a QSST is a qualified subchapter S trust, and only certain trusts are eligible to be S corporation shareholders. So there's certain rules you need to be careful about in determining whether you have a good trust that can qualify as a QSST. QSST trusts are very similar to what a traditional marital deduction trust would look like. All income must be distributed annually to the beneficiary, but as Steve suggested, the trust doesn't actually have to require that all income be distributed. It just is the fact that income actually has to be distributed out to the sole beneficiary of the trust. And
so you really have your option with that.
Mm-hmm.
If it's mandatory income, then you don't really have to look to see whether income was actually distributed. And then if it's discretionary, then you actually have to look to see where they got distributed. Go ahead.
So there can only be one beneficiary of the trust. So again, similar to a Q-tip type of trust, to be a QSST, there only can be one beneficiary during that beneficiary's lifetime. And again, if it's a mandatory income trust, then it's not as protective as a trust that would allow the flexibility of accumulating income over time.
So now we're going to flip the paradigm. The paradigm we were just talking about was where the beneficiary has lower rates than the trust does. Now let's flip it and say that suppose the trust has a lower rate than the beneficiary. As I mentioned earlier, for example, you had those phase-outs of the itemized deductions, and the trust would be actually taxed at a lower rate than a beneficiary if they were both in the top bracket. We also talked about state income tax, that a trust might be a non-resident and not be subject to income tax in a particular state, whereas if you distribute to the beneficiary, the beneficiary themselves might be subject to state income tax. So what do? You make an ESBT election, and that automatically traps the S corporation income inside the trust. And again, if you don't have an existing S corp, you can contribute the assets to the S corp. And again, with an ESBT election, you have the ability to toggle.
So ESBT trusts are a lot more flexible in terms of what will actually qualify for this election as opposed to a QSST. So they can be sprinkle trusts, they can have multiple beneficiaries, but as Steve said, then all the S corporation income is taxed at the trust level and not to the beneficiaries. So it may be important to divide trusts between the S corporation stock in one trust and all other investments in another trust, taking into account that the income is going to be taxed at the highest income tax bracket for these type of trusts. We are going to talk in just a second about some flexible trust design that may be important in deciding which way to go on these. So flexible trust design for spouses. In many cases, we don't want to use a sprinkle trust for spouses. We prefer to have a single beneficiary trust, which would allow us to make a decision between a QSST election or an ESBT election, and also between making a QTIP election or causing the trust to eventually be included in the spouse's estate when the spouse subsequently passes away. So we find that this typically gives the most flexibility in making these types of tax elections. Flexible trust design for children. Again, when you're at the drafting stage, considering how to draft the trust that creates the most flexibility down the road for children. And again, we often opt for a single beneficiary trust rather than a sprinkle trust among multiple beneficiaries. And again, this gives us flexibility to toggle potentially between an ESBT and a QSST. And we also, in many instances, give the beneficiary inter vivos power of appointment, which also creates some flexibility in the trust provisions in making distributions out to the beneficiary.
With an ESBT, I mentioned that the S corporation's income is all trapped at the trust level for tax purposes. If you distribute cash out to the trust and then it reinvests those, and then you have an investment income that's inside the trust, then any distributions from the trust will carry out that income. They don't carry out the S corp income, but they will carry out that other income. So what you might want to do to be able to have more flexibility with toggling is whenever you make S corp distributions, you split the trust up, and you have the ESBT make a distribution out to a separate trust. And that separate trust holds the investment income. And so the investment income can be trapped inside the trust. And then when the ESBT makes distributions, it doesn't carry out any income because the investment income is all in a separate trust, and the other ESBT's and only other income would be from the S corp. So that's a way to do that. The first time you toggle between QSST and ESBT, there are no time restrictions. For subsequent toggling, there's a 36-month wait. Also, whenever you do convert something from to a QSST, you have to turn off the inter vivos power of appointment, and so that's a permanent change. You don't have to make it mandatory income. You can make it discretionary income, or you can even provide that when you toggle back, it goes from mandatory income back to discretionary.
So even when we have those old and cold trusts, there still may be ways to modify the trust to provide them with more flexibility. And one way to do that under the Uniform Trust Code is for the settlor and all the beneficiaries to enter into a trust modification agreement, depending on your state, that may be available. And the other way that I mentioned earlier is potentially decanting, and which is the trustee taking action. If there's distributions allowable for welfare, the trustee can move the assets from the current trust to a new trust that may have provisions that are more flexible in what you're trying to do. Again, we just talked briefly about helping the trustee cut down their liability exposure by providing notices to the beneficiaries, and if the trustee adequately discloses the existence of a potential claim and informs the beneficiary of the time allowed to commence a proceeding, in UTC states you can cut the time from 5 years down to 1 year. So if you have litigious beneficiaries, they have to complain sooner rather than later. And even if everybody seems to be getting along, it's good to give these notices when everything seems to be going well and not wait for the situation to occur where somebody's unhappy. So Steve's material that he referenced has some sample notices that can be helpful to the trustee in limiting his or her exposure.
So I hope you've had some good takeaways. I don't see any questions in our chat box, but you're certainly welcome to call us or email us. Our contact information is on the final slide. But before we get to that, I have over 1,200 pages of business structuring materials that are a little bit more searchable than what we sent here. And so you're welcome to email me to get those. I also have a quarterly newsletter that has the most recent version of that. So if you subscribe to my quarterly electronic newsletter, then you can always get the latest on those materials, including any changes I've made to update it for fiduciary income tax issues.
And the potential new changes that may come in down the road.
Absolutely.
Steve will have his work cut out for him.
Yep. And in addition to doing the newsletter, I also do a quarterly webinar which covers the newsletter. And my next quarterly webinar is on April 25th, same time, same bat station, so to speak. And then before I do my wrap up, you know, we're talking today about taxing between trust and beneficiaries. We're talking about tax reform. So I need to give you a quote from the great Senator Russell Long. He said, "Don't tax you, don't tax me, tax the man behind the tree." So we'll see how things work with that. Look forward to getting your evaluations. Please go ahead and email those to us. And I hope you tune into that. Connect with us other ways. Subscribe to my blog. Sign up for newsletters. Contact us.
And thank you for joining us today.